Welcome to Wealth Hustle 247 podcast, your trusted guide to financial literacy, business innovation, and entrepreneurial success. Learn how to grow your wealth, make informed decisions, and turn your ideas into profitable ventures.
Crypto is booming, but are you investing the smart way? Today, we're breaking down everything you need to know before putting your money in Bitcoin, Ethereum, and beyond. Stick around. This episode could change the way you invest forever.
Welcome to the deep dive. Today, we are wading into waters that usually come with an absolute tidal wave of noise, hype, and, well, let's be honest, a whole lot of fear. We are talking about cryptocurrency.
Oh, yeah. The hype is real.
It really is. But before you tense up or roll your eyes, thinking this is going to be, another wild pitch about getting rich quick or some apocalyptic warning, let me stop you right there. We are taking a completely different approach for you today.
Exactly.
Our source material isn't a thread from some flashy online influencer promising you the moon. Instead, we have our hands on a really grounded, highly practical paper. It's simply titled Cryptocurrency Investing What You Need to Know.
It's a great piece.
It is. And the perspective here is what makes it so incredibly valuable. It's built on a 40-plus year perspective, drawing deeply from traditional business, market cycles, and just solid financial intelligence.
Which is exactly the kind of sober lens we need right now. Because when you look at cryptocurrency, it really represents a major technological and financial shift. It is arguably one of the most profound structural shifts in how we handle value in our lifetime. And yet, simultaneously, it remains one of the most misunderstood asset classes in modern history. The gap between what it actually is mechanically and what the general public thinks it is staggering.
Exactly. And that gap is where people get hurt. So our mission for this deep dive is incredibly straightforward. We are going to strip away the emotion.
Right.
We are taking a machete to the unrealistic expectations, and we are going to provide you with a disciplined, fact-based framework so you can actually understand crypto investing. No hype, no fear, just the mechanics of how it works and how you can approach it logically.
That is a critical mission because when you are dealing with a widely misunderstood asset class, having a disciplined framework isn't just a nice to have. It's your absolute primary defense mechanism.
Okay, let's unpack this. Look, if you're listening to this, you probably already have a basic idea of what digital money is. You know what a blockchain is. But what makes this 40-year perspective so refreshing is how it strips away the tech bro jargon and forces us to look at it purely structurally.
Yes. Structure is everything here.
It defines cryptocurrency as a digital asset secured by cryptography and built on blockchain technology. But it's the structure of that ledger that really changes the game, right?
Absolutely. The structural difference is everything. The framework emphasizes that a blockchain is a decentralized, publicly verifiable ledger completely free from central authority control.
Completely free.
Right. If we connect this to the bigger picture, think about how traditional finance works. A bank holds a private ledger. They are the central authority. They dictate what transactions are valid, they control the access, and they can alter or freeze your accounts. A blockchain flips that entirely on its head.
Which is wild when you really think about it.
It is. It is decentralized, meaning no single entity owns the network. And it is publicly verifiable, meaning anyone, anywhere, can check the math and confirm that a transaction occurred. It completely removes the need to trust a middleman.
It's the difference between asking a bank for permission to move your money and just moving it yourself because the underlying math guarantees it.
Exactly.
Now, once you grasp that structural foundation, you look out at the crypto universe and, well, it can look like an absolute mess. There are thousands of different coins. To keep you from getting overwhelmed, this financial intelligence breaks everything down into 4 major distinct categories.
It's just so helpful.
So helpful. The first is store of value coins, and the undisputed heavyweight champion here is Bitcoin.
Yes, Bitcoin. And what's fascinating here is the specific notation of the digital gold thesis.
Yeah.
Bitcoin has a mathematically limited supply. Just like there is only so much physical gold in the earth, there will only ever be a set amount of Bitcoin. That built-in, unchangeable scarcity is what drives the idea that it can hold its value over long periods, acting as a digital alternative to gold.
Okay, but let me push back on that for a second. If Bitcoin is supposed to be digital gold, why is it so volatile? I mean, gold is supposed to be stable, right? If Bitcoin drops 50% in a few months, how is that a store of value?
That is the exact friction point the framework addresses later when we get into market maturity. It's a store of value in its design. The scarcity is absolute. But because the market is still so early in its adoption curve compared to physical gold, the pricing remains highly volatile.
Ah, I see.
Yeah, it is an emerging store of value, heavily subject to human psychology right now.
That makes sense. It's the design versus the current market reality. Okay, moving to the second category, smart contract platforms. The prime example given here is Ethereum. If Bitcoin is trying to be digital gold, Ethereum is described as the infrastructure layer for decentralized applications.
Right. It's not just a coin.
It's a programmable network.
Exactly. Think of it like a digital operating system. You can build other software, other financial tools, and entire automated protocols right on top of it.
Right.
It is the plumbing for a new kind of internet-native economy.
Which brings us to the third category, one that I think really often confuses people who are new to the space, stablecoins. The text points out specific ones like USDT and USDC.
Yes, very important category.
Now, unlike Bitcoin or Ethereum, whose prices are bouncing around all day, stablecoins are actually pegged to fiat currency. And by fiat, we just mean traditional government-issued money like the US dollar or the euro. So one stablecoin is generally designed to equal exactly one US dollar.
And this is a crucial point for you to internalize if you're building a portfolio. You don't buy a stablecoin expecting it to double in value.
Definitely not.
The framework highlights that stablecoins are used primarily for trading and liquidity. They are the stable holding ground within the volatile crypto ecosystem. Think of them like chips at a casino.
Oh, I like that analogy.
Yeah, they let you move in and out of riskier positions quickly without having to constantly wait days to transfer money back and forth to your traditional bank.
They are a tool, not a lottery ticket.
Yeah, it's like that.
And that leads us perfectly to the fourth and final category, utility and speculative tokens. This is where the danger really ramps up.
Oh, absolutely.
These are much higher risk and are heavily driven by hype. They might offer access to a specific service, but a lot of the time, their price movements are completely divorced from any fundamental value. It's kind of like trading penny stocks based on internet rumors.
Precisely. And that naturally forces us to confront the elephant in the room.
Yeah.
You cannot talk about crypto without talking about the extreme price swings, the volatility.
Oh, 100%. When you hear about crypto in the news, it's usually because the price has either shot to the moon and made some teenager a millionaire, or it's plummeted to the center of the earth and wiped out a hedge fund. Why is this market such a violent roller coaster?
Well, this 40-year market perspective explicitly lists the mechanics behind this volatility. It isn't random. It's driven by very specific structural realities. First, as we touched on, it is an early-stage market. Compared to global equities or global real estate, the total money in crypto is still relatively small.
Right.
That means smaller amounts of capital moving around can move the overall market price significantly. Second, pricing is heavily sentiment-driven. Traditional valuation metrics, like a company's quarterly earnings or a stock's price-to-earnings ratio, they simply don't apply to most cryptocurrencies. Therefore, the price is largely dictated by collective market psychology at any given moment.
So if it's an early stage market driven by sentiment, it's basically highly susceptible to every piece of news that drops.
Exactly.
And on top of that, you have regulatory changes looming large over the entire industry. A single rumor about a new law in a major country can send the entire market into an absolute frenzy. Plus, and I think this is a huge one for you to remember, it is a 24/7 global trading environment.
Yes, that's a massive factor.
The traditional stock market closes, you can go to sleep, wake up, have a coffee, and rationally assess things. Crypto never sleeps. It is trading around the clock, all over the planet.
And that continuous trading means momentum can build rapidly in either direction without any of the traditional circuit breakers that the New York Stock Exchange uses to halt a panic. This creates incredibly rapid liquidity shifts.
It is the ultimate double-edged sword. The source puts it very bluntly. This volatility allows for large gains, but equally large losses. You cannot extract the massive upside without opening yourself up to the massive downside.
You really can't.
And that requires a serious risk reality check. The framework provides a sobering list of specific structural risks you face when you step into this arena. Let's run through them.
These are risks you need to deeply internalize because they differ from traditional finance. We mentioned regulatory risk. The rules of the game can change overnight. There is technological risk. At the end of the day, this is software. There can be bugs in the underlying code. Then there is custody risk, which is highly unique to crypto. If you hold your own digital assets and you lose your cryptographic passwords, that wealth is just gone. There is no 1-800 customer service number to call to reset your password.
That is terrifying, just completely gone. Then you have exchange failure risk. If you keep your funds on a centralized trading platform and that platform goes bankrupt or is poorly managed, you might lose everything. Add in the extreme price swings we just talked about, and finally, fraud exposure.
Unfortunately, yes.
Because it's a global digital frontier with irreversible transactions, bad actors are constantly looking for ways to scam people. Knowing all of this, the foundational golden rule from the text is absolute. Invest only what you can afford to lose.
It sounds cliche, but people routinely ignore it. If a total loss of your crypto investment would alter your lifestyle, delay your retirement, or threaten your financial security, you are overallocated. Plain and simple. The risk must be contained.
So what does this all mean for your actual portfolio? How do you practically apply a 40-year market perspective to something so new?
The text actually defines strict allocation buckets for you.
Yes, very clear buckets.
If you are a conservative investor, the framework suggests an allocation of 5 to 10% of your overall portfolio. If you are an aggressive investor, you can look at 10 to 20%.
And this is where that disciplined intelligence really shines. As the text explicitly states, risk containment protects long-term wealth. By strictly capping your exposure at 10 or 20%, you are ensuring that even if the absolute worst-case scenario happens and the asset class goes to zero, your broader financial foundation survives.
Exactly.
You are taking a calculated, asymmetric risk, not making a blind gamble with your livelihood.
Okay, let's unpack this further.
Yeah.
Say you've decided you're going to allocate 10% of your portfolio to crypto. What do you actually buy with it? The strategy breaks down into core versus speculative allocations within that specific crypto bucket.
Your core should make up 70 to 90% of your crypto portfolio. And for this, you stick to the heavyweights, Bitcoin and Ethereum.
The rationale there is purely about survival. In an asset class defined by extreme volatility and risk, you want the vast majority of your exposure anchored in the most established, most tested, and most liquid networks.
Think of your core allocation like the foundation of a house. It's not necessarily the most exciting part, it's just concrete, but it keeps the house standing when the wind blows. Then you have the speculative bucket. This is the remaining 10 to 30% of your crypto allocation.
The fun stuff.
The fun stuff, right. This is the fancy glass chandelier. It looks great, it might dazzle you with large percentage gains, but if there's an earthquake, it's the first thing to shatter. This is where you look at smaller projects, which the text explicitly notes carry much higher risk.
You are venturing significantly further out onto the risk curve. The likelihood of those smaller speculative projects failing entirely is exponentially higher than Bitcoin or Ethereum.
Now, here's where it gets really interesting. You've decided your allocation, you've bought your assets. Where do you actually put them? We're talking about purely digital money, but the intense irony here is that it desperately needs physical security.
It's quite the paradox.
The paper outlines your options, starting with exchange storage. This is where you just leave your crypto on the platform where you bought it. It is unquestionably the most convenient option. But the text warns it is also the riskier option because you don't actually control the underlying assets. The exchange does.
This raises an important question for you to consider. Do you value day-to-day convenience over absolute security? If you want to take true control, the text offers two other options. The first is a hardware wallet.
Okay.
This is a physical device, often looking like a standard USB drive, that secures the cryptographic keys to your assets. It is significantly more secure than leaving them on an exchange because the keys remain in your physical possession.
And the final option, the absolute fortress, is cold storage. This is complete offline protection. Your keys are generated and stored completely disconnected from the internet, making it practically impossible for a digital hacker to access them from afar.
Right.
And the key takeaway from the source material is stark here. Security negligence has literally cost investors billions of dollars entirely wiped out simply because people didn't take the storage of their digital assets seriously.
It's a harsh, unforgiving reality. In traditional finance, if your bank is robbed or your credit card is skimmed, you are usually insured or reimbursed. In crypto, if your security is breached, the loss is permanent.
So if you've locked down your storage and you're feeling secure, you might think you're totally safe. But that ignores the psychological warfare of the market itself. How do we navigate the actual cycles? The text walks us through the inevitable phases of a crypto market cycle, and it's a brutal emotional test.
What's fascinating here is how predictable human psychology becomes when plotted on a chart over decades. The text outlines the cycle phases clearly. It begins with accumulation. This is when the market is quiet, prices are depressed, and disciplined money is slowly building positions.
Quiet and boring.
Yes. Then, sentiment shifts into a bull market. Prices rise, media attention grows, and excitement builds. This inevitably leads to the blow-off top.
The blow off top. This is peak frenzy. It's when your neighbor who has never invested in anything is suddenly giving you crypto advice over the fence.
Exactly.
Everyone thinks the price will just go up forever and the FOMO is overwhelming, but it doesn't last. The blow off top is always followed by a crash. Prices plummet violently, shaking out everyone who bought at the peak in a panic.
A painful phase.
Very. And finally, you enter the bear market, a prolonged, painful period of depressed prices and total apathy, which eventually settles back into the accumulation phase and the whole cycle repeats. The text emphasizes that successful investors accumulate gradually, and, this is the hardest part, they leave their emotions completely at the door.
Because if you let your emotions drive, you will do the exact opposite of what the framework suggests. You will buy during the blow-off top out of pure greed, and you will sell during the crash out of pure fear.
Speaking of doing the wrong thing, the source provides a rapid-fire list of common mistakes you need to actively avoid. Let's run through them. Investing essential living money. Using leverage, which simply means borrowing money to amplify your trades, an incredibly efficient way to lose everything fast.
Very fast.
Following influencers blindly, ignoring security, chasing unrealistic gains, and of course, panic selling.
Every single one of those mistakes stems from a lack of structural discipline. And there is one more area where a lack of discipline will severely punish you, and that is taxation. The framework provides a very sobering reality check. Crypto transactions are taxable in most jurisdictions.
Yeah, the tax man cometh, even in the decentralized future. If you sell a coin for fiat currency, that's a taxable event, but it goes deeper. If you swap one cryptocurrency directly for another, say trading your Bitcoin for Ethereum, that is often classified as a taxable event too.
People miss that one all the time.
Even using crypto to purchase a physical item can trigger a tax liability. The text is abundantly clear. You must meticulously track your sales, your swaps, and your purchases carefully.
If you wait until tax season to try and piece together hundreds of different trades across multiple platforms without any organization, you are going to have an absolute nightmare on your hands. Structure and organization here are just as vital as your actual investment strategy.
We are coming to the final stretch here, the long-term outlook and final advice. You've got the framework, you understand the foundational technology, the risks, the brutal market cycles, and the taxes. But where is all of this actually going? The 40-plus year intelligence of the text outlines 3 possible futures for the crypto space.
If we connect this to the bigger picture, the macro outlook is entirely dependent on adoption and regulation. The first possible future is that cryptocurrency becomes mainstream financial infrastructure. It seamlessly integrates into the global economy, becoming the invisible backbone for how value moves around the world.
The second possibility is that it remains a niche speculative asset. It survives, it continues to trade, but it never really changes the fundamental structure of global finance. It just stays a volatile, alternative playground for traders.
And the third future outlined is that it becomes a heavily regulated sector. Governments step in globally, impose strict frameworks, and fundamentally alter how the asset class operates, potentially stifling its decentralized ethos in exchange for institutional compliance.
Wait, so the advice is to prepare for all 3. How do you even do that? The text advice is simple. You prepare through diversification and discipline. You don't bet your entire life savings on just one of those outcomes happening. Which brings us to the final mantra of this incredible source document.
It's a great summary.
It asks you to adopt a very specific philosophy. Treat crypto as a calculated risk. Treat it as a technology exposure within a broader portfolio, and treat it as a portfolio enhancer, never ever a replacement for a diversified financial plan.
And crucially, the text warns, never invest from hype or FOMO, the fear of missing out. If you feel that anxious, burning urge that you have to buy right this second because a coin is skyrocketing, step away from the screen. That is emotion talking, not discipline.
So what does this all mean? The ultimate takeaway from this 40-plus year perspective really comes down to 3 powerful sentences. The expert is going to read them to you because they truly encapsulate everything we've discussed today.
The text concludes with this guiding principle. Survival comes first. Growth comes second. Structure determines long-term outcome.
Survival comes first. If you blow your account by over-leveraging, or if you lose everything because you were negligent with your hardware wallet, You aren't around to catch the growth anyway. You have to build the structure, the security, the strict allocation limits, the emotional discipline before you can ever expect to win in this space.
Well said.
Well, that wraps up our deep dive into the practical, hype-free realities of cryptocurrency investing. Thank you so much for joining us. We hope this framework helps you cut through the deafening noise and approach this incredibly complex, volatile, and fascinating asset class with a clear, rational mind. Navigating this space isn't about getting lucky, it's about having that disciplined framework and protecting yourself first and foremost.
As we wrap up, I want to leave you with a final thought to mull over on your own. It builds directly on the concepts we discussed today. The idea of digital gold, the reality of billions lost to negligence, and the absolute necessity of offline cold storage.
Let's hear it.
We spent this entire deep dive talking about a revolutionary, purely digital, decentralized asset class that is meant to be the future of finance. But isn't it intensely ironic that the absolute safest way to protect this futuristic digital wealth cold storage requires you to take it completely offline, reducing it to a physical piece of hardware hidden in a drawer? As we rush toward a fully digital financial future, is the ultimate security measure just the modern equivalent of burying gold in your backyard?
It really makes you think about what it actually means to hold value in the digital age. Thank you again for being here with us. Keep questioning the hype, keep building that disciplined structure, and most importantly, stay curious until the next deep dive. See you then.
That's it for today's episode of Wealth Hustle 247. Be sure to follow, like, comment, and share with others. Keep pushing toward your goals, and we'll see you in the next episode.